Welcome back to the channel. I'm Foreman, and in this video I'm going to be talking about the UK stocks I'm buying now, as well as updates on a few different companies such as Aston, Darktrace, Sylvania Platinum, Halma, Boohoo Group, and also Frasers Group. So we have a good mix today, and hopefully it is interesting. Although I will admit I'm in a little bit of a rush today, so I'm going to try and keep things brief. But I've also not read some of the articles, so obviously I'm going to cut down anything that isn't good. But I think we're onto something here, and this could work quite well. Regardless, my portfolio, it is only 4:45, so I'm not sure if the cross trades have been checked. But my portfolio for the week is down 5.71%. What a surprise! I'm down yet again. And yes, my cash position is now at 0%. Do not worry, in a few days' time, I'm therefore going to top up, and that cash position will be more than 5% at the current levels. It would be closer to 10% because obviously the total value has very much been hammered. Although a few days ago I was down at nearly 50% overall, so we have seen a little bit of a bounce back recovery here, although let down a little bit by Games Workshop. Again, I'm down nearly 51% on Boohoo. I'm going to keep averaging down as much as possible. I think over the next few weeks now, scale in some serious amounts of money because I don't know how much lower this can go. Obviously, I'm not a fool, and I'm not going to say, oh, it can't go much lower, because it usually does. However, my prediction, based on purely speculation of market euphoria and fear and greed, etc., I think in the next month or two we're going to see sort of things recover and go back up. But I think the indices or the indexes such as the FTSE 100, well, maybe not the FTSE 100, but the ones like the Nasdaq and the S&P, I think they've got a little bit further to go down. The reason I might disagree a little bit more with the FTSE 100, and it might only just touch correction territory, this is because it's mainly full of value stocks, old world stocks, tobacco, banks, companies that have a lot of cash flow, and he swore then. So they are obviously easily able to weather inflation, whereas a lot of the growth stocks like in the Nasdaq, obviously they have a lot less earnings, and therefore if inflation is around about 5 to 7%, they're going to have to earn more than that. And obviously a lot of the companies like Boohoo can't pass the cost to the customer, and so obviously their margins will be hit in the medium term as well. That being said, I have bought more shares of Boohoo this week. I haven't got the exact figure for you, but it's increased by about 300 or so. And I think in the last video, my average price from Boohoo was roughly £1.74.72. It's now £1.72.50, and my total number of shares is 11,714, with plans in the future to certainly add to that and really ramp it up. Games Workshop is in my sights at this current valuation. I do think it's a little bit too frothy at the moment because we've got to take into account their latest results. I think things certainly did slow down a bit, and therefore there is an element of caution to have here. They're trading at roughly a PE or price to earnings ratio of the trailing 12 months, meaning the last year, of about 18 to 19 times, which with a price to earnings ratio you'd want to see earnings grow by about a similar amount. I don't know if they've got that within them, because lately in their recent results we saw volume decline but royalties increase. Total War Warhammer 3 so far has done very well. That'd be great for their licensing, their brand awareness, their intellectual property, but ultimately are we going to see this transfer into retailing and miniature figures? And then again, it was quite a slow period in the last report. There weren't any massive launches, so perhaps this is actually something to be buying in on, although at the moment obviously Boohoo has dropped by a much further amount. I'm down underwater by a lot more. Don't get me wrong, I'm not averaging down on Boohoo purely because it's down. I have high conviction that I can therefore say, you know what, I could have 80% of my portfolio in Boohoo because I strongly believe in the long-term prospects of the company. I'm not after a short-term trade. I don't care that I'm underwater at the moment. That's fine, because ultimately I think in 5 years' time this stock will be worth a hell of a lot more than it already is, hence why I'm buying substantially, so that when it does eventually recover, my position will be well placed to gain from a majority of the upside, rather than waiting a long while for it to break even and then cut my losses. Why would I do that? If I wanted to cut my losses, I'd do it now. And a lot of people have been challenging me, just cut your losses and invest elsewhere. Okay, what stock? Go on, pull it up, because I think Boohoo has a lot of upside, and obviously someone is going to get a stock that's more. It might be more speculative, but ultimately I understand the business of Boohoo. It's not complicated, and this will recover providing the story doesn't change. I anticipate in April, when they release their full year results, I anticipate that this will actually be quite poor. I'm expecting that, but I think the markets have priced down a lot worse, and that actually in the next few years the earnings will be Terrible. Anyway, on to the news this week. Sylvania Platinum released their half-year results. They're a little bit disappointing compared to the likes of Rio Tinto, for instance, which in reality I should have probably brought up because it is quite interesting. Regardless, they've delivered 32,376 ounces of their platinum group metals, whereas compared to this time last year, it's 36,300. Their net revenue was nearly 70 million, but it's 69 million, and their half year, well, this time last year was $84.9 million. This is due to a combination of their average gross basket price of their PGM is now $2,960 per ounce, compared to last year it's $3,000, nearly $200 per ounce. Obviously their EBITDA, or their earnings before interest, taxes, depreciation and amortization, has also declined quite substantially to $36.2 million from $58 million, and so obviously things have changed. However, the good thing here is that their cash balance has increased to $110 million from $67.1 million, and they have signed for the sale of their share in a mine, a chrome mine, to blah blah blah, and it's going to sell for about $7 million. And they brought back nearly 9 million shares from employees, all transferred to Treasury. A great sign indeed. And obviously they've released a lot more dividends, windfall dividend and a final dividend too. Obviously there are some challenges in place, but overall I'm quite happy with this. If you can understand all the plant feed, it's all here for you. I'm interested in cash flow, and let's see how much their capital expenditure has changed. So we're in USD, so we're looking at the left-hand side, the far left column. We've seen an 198% increase in capital expenditure, although quite a substantial drop in net profit. And that would be interesting because taxation is obviously going to be the same, but less because they've earned less. And I'm not sure. I think operating costs have risen by about $4 million, but overall, due to the fact they've had sales adjustments as well as a decrease in revenue, overall they are down. Again, this is a very small position for me because I have no unique advantage in the miners. It's in my SIP and I hold a few shares. I think it's 45, or I own £45 worth of shares, which is about 45 shares actually, I think, roughly. And so obviously it's a very minimal position, but they pay a good dividend, they have no debt, and they have plenty of cash on the balance sheet. I think therefore diversification is protection against ignorance. I don't understand this industry. I mean, I can understand the profits and the cash flow, and I think they're a well-positioned business in the industry. They're not worried about concerns about Russia like Eurasia Mining or even FRAS, and I think they're based in Mauritius, which is an island off the coast of, is it Madagascar, near Africa? And so obviously I think, or is it Mauritius? I can't remember actually, it might be different. I'm thinking of Mauritania from RuneScape. That is a shout out right there if you know what that is. Anyway, interesting company, done quite well. Well, I'm happy to continue holding. I think this is just going to be a long-term dividend play. Ultimately, it's not in my growth portfolio because I want to understand the companies in my growth portfolio very, very easily like that. Darktrace has acquired an attack surface management company called Cybersprint. They have paid 47.5 million euros in cash and equity. So once more, they're eating away further at their cash position. 75% of this deal in cash, 25% of this in equity. They've paid at approximately 12.5 times their annual reoccurring revenue, but I suppose that is good if they do believe that this is going to grow in the future. Obviously, Darktrace are unprofitable, but I think they have positive cash flow, but that might just be due to the fact that obviously they have recently IPO'd. A company I like. I think it's in a good industry. I think cybersecurity is very much going to grow, but I don't know enough about it and it's well out of my depth. I don't know who Cybersprints are. They are highly complementary apparently to Darktrace, and it will be a good, obviously, fit where it builds synergy. But ultimately, this is well out of my knowledge, therefore I can't really buy, especially as it doesn't have earnings. And they did, obviously, they IPO'd and then they decided to buy back shares, which I thought was a little bit ridiculous because I thought the whole point of IPOing is to become public to raise capital, but then to use that capital to then buy back the company that you've just sold at an inflated price seems ridiculous to me. But I think they were just trying to appease shareholders there or reach their perhaps executive bonuses. But anyway, interesting company. They have done very well in their recent results, which I have commentated about a few weeks ago. So they are certainly growing. It's just a case of will they grow and will they be able to sustain profitability in the longer term future. But again, you're invested in Darktrace for the revenue growth and the cash flow rather than that of the earnings at the moment. It's very much early stage. Aston Martin, not a stock I've spoken about in a while. This was actually one of my stocks to avoid. Didn't like this company very much. I thought they were heavily ridden with debt. I think they've been bankrupt 6 times in their history, maybe more at this point. And so obviously I've I've kept clear. Love the cars, think they are very, very beautiful looking cars, and I'd love to own one in the future, or maybe a McLaren, I think I prefer. But ultimately, they are talking about their Valkyrie vehicles, which they're trying to do the first true F1 car on the road. I found this quite amusing. I don't know how much they retail for. I think it was about $3 million. But what made me laugh is that they've retailed 10 of the vehicles so far this year. But that's due to global supply chain disruptions. But in the next year, I believe, they're aiming to ship between 75 to 90 of these vehicles in 2022. You do the maths on that. Let's just say it's 75, for instance. You use 75 times 3. Let's get out the old Casio calculator here. 75 times 3, and you're looking at £225 million or $1 million, sorry, worth of revenue there. I don't know what their profit margins on it, but it's a luxury car, and the more obviously they produce, the better likely, and they're likely going to really start charging for this. So obviously that is a good path for revenue if they are able to make it grow. And then they're also expecting to achieve 10,000 overall wholesales, £2 billion in revenue, and 500 million adjusted underlying earnings, EBITDA, by 24 to 25. If they're able to achieve this, that's great. And they're looking to grow their vehicle fleet or their wholesales by 500 to over 6,600 this year, hoping that 75 to 90 of those will come from their new Valkyrie supercar. Interesting, their losses have been narrowed and it's gone down here, and actually they've seen revenue surge 79%, obviously with the easing of COVID restrictions. So I don't know what the price of this at the moment is, but I don't know if it's worth investigating as a possible recovery play, the potential of them getting in the F1, and obviously their luxury cars are very, very well sought after. I was surprised they're not bought out already, but again, interesting one to be looking at, although I remember looking at the fundamentals before and felt that I had to strongly avoid that. But again, I suppose it's more of a nationalistic thing. It's a good British company. I guess if you wanted to punt some money on it, it'd be quite entertaining. I do believe it's now, well, it was a penny stock, and then I think they did a reverse share split, so it's now like £10 a share or something. Could be worth a punt. I don't know. I'm not suggesting to buy this, but I definitely like to follow it because it is obviously one of those that I think all of us are slightly interested in, being a British company. Not saying I'm biased to a patriotic bias. I've spoken about this before. I just like the interest, and obviously there is obviously some form of nationalistic pride in people, and I think just this is one of those companies that you want to have a good look at and just see how they're doing. Wish them well, right? Not necessarily invest in them. Don't invest in them just because you're nationalistic, but if you're trying to punt or gamble on it, hell, that's up to you, isn't it? It's your money at the end of the day. Although I would have done something similar. Mike Ashley's at Frasers Group buys studio retail out of administration. Now, this is interesting because he has absolutely slated this company. He said that they were very much out of the times, and I can't find this, but he definitely said this in this, and I have read this in advance. And apparently they tried to get, they were a market value of £100 million. Shares were suspended last week, and they requested £25 million of a loan, which was turned down by their bank HSBC. So what ultimately ended up happening is that Frasers Group ended up buying this company for £26.8 million, saving 1,500 jobs for now. And they sell a mix of cut price own branded products, from clothing and furnishings to gifts and cards. So roughly a load of old rubbish probably. And again, I've not been to their stores, I've not been to Findle. It might actually have a very good unique selling point. Again, this is just not something I would probably be buying from. But then again, cut price own brand products, I would have a look. I definitely would, that's for sure. Now, they already owned nearly 2/3 of this stock and called on the government to urgently increase a meaningful regulation of UK business. They said that, let's have a look here, where did they say it? Studio retail was another example of a business which had buried its head in the sand whilst the world around it changed. As I was talking, not getting with the times. Furthermore, it's clear that the fundamentals of the business were, at best, inadequately scrutinised by its board and or advisors to the business, or at worst, deliberately concealed as the business entered its death spiral. Now, that is interesting indeed. One to follow, Fraser, Mike Ashley, very, very, very successful guy. If you're following the retail industry, he is one to follow indeed, especially in the UK. Now, Boohoo, this is an amusing article to me because when I last had heard of Roblox, I've seen it pop up again. They IPO'd recently. For those of you who don't know, for instance, Roblox was a kid's game. I don't know what's happened to it now, but it's certainly become this metaverse pig. Don't get me wrong, I've looked at it a few times in the last few years, as in the game itself, and I thought, you know what, it's free, it's a good laugh, and it's a rip-off of maybe like Call of Duty, and you get to run around as a big blocky character. And I thought, you know what a laugh. Can't complain with that, it's free. And at the end of the day, Roblox was one of the most addicting games when I was a kid. And back then, I'm talking 10, maybe 13 odd years ago at this point, where it was a lot more limited. You'd have a little spawner and zombies. I'm not going to bore you guys that aren't into video games into this, but it was a lot more limited. But now they're on about doing like advertising on this. So Boohoo have strutted into the metaverse by advertising on Paris Hilton's Roblox Island. Paris Hilton and a kids game. I can't imagine that mixes very well. I don't think Paris Hilton's that relevant anymore, but hey, at least they're entering these virtual islands. And I guess it's a good idea because a lot of people are on these games. I, in hindsight, should have looked at it, but I imagine one of you will be able to say the like concurrent player count of Roblox, and I imagine it's probably in the millions at least. It's a free game and it's a very popular one. And again, it just makes me laugh because obviously Roblox has their own unique design, and Paris Hilton, she's got to be getting on at this point. So it is quite interesting. But apparently at Paris World, users are given the opportunity to feed animals at a zoo, ride the wheel, play mini games. So I guess Boohoo having their sign there, it's a good subliminal advertising. But then it says they've joined other brands with Hilton, including Warner Music Group, Ralph Lauren, and Hyundai Motor Company, which have also expanded into the metaverse. But it is a buzzword at the moment, and I don't know obviously if they're on Paris. Oh, it is, yeah. I was thinking of Hilton Hotels, but that's Paris Hilton. And obviously those brands have decided to advertise with her as well. So there is certainly something there indeed. One good comment here is against with Boohoo and Next, and that they were wise to launch their own brand beauty ranges. Now, they talk about how well UK beauty, not Bruty, I suppose that's quite the opposite, isn't it? And e-commerce in this particular for grooming has surged by 42% in 2020. Obviously, this is due to the pandemic, but it's desire for convenience, time saving, and lower prices. Now, they're suggesting that the UK's wider online health and beauty market was set to surge further, hitting a net worth of £6.6 billion, but growing at a CAGR, a compound annual growth rate, between 2019 and 2015 of 10.4%. That's double-digit growth. That's pretty good for an industry. Well, I suppose it's the e-commerce section of it, and I think that's good indeed. Beauty is where the profit margins are at. This is why Boohoo acquired Debenhams. They are very much going to diversify into this, and they're going to become less of this fast fashion company and more of this fast beauty company, I guess. Beauty is so strong of a market to be in. It's very competitive, don't get me wrong. You can have premium products charge insane margins on this. Obviously, the products are very easy to source themselves, but they're consumable. People will use the beauty products or they will expire over time, and people have to keep coming back and buying more. At least with clothing, they can last years. And realistically, a lot of this Boohoo clothing that I'm wearing, every piece of my outfit other than my accessories, is actually Boohoo at the moment from top to bottom. Not going that deep, but you know what I mean. And like the quality of it is good. I like it. I mean, this is Burton obviously, but it's owned by Boohoo. Quality's good. What I'm saying here is they are key beauty players, and this is something to be watching in the future. This is where the growth is of the company going forward. Yes, the fast fashion is going to grow as long as they remain trendy, but with beauty, you don't have to remain as trendy. You set out the products, you leave them available. All you have to do is promote sales like Boohoo do, and boom, you're going to be getting sales like that, revenue growth very much so. And they've already got the infrastructure to do this. And obviously, if people are going to want beauty products to go out the next night and they want it quick, they're going to want disposable or very much consumable. Yes, it's not very environmentally friendly, but if they want a fancy lipstick for the night out tomorrow, Boohoo will be able to deliver it that quickly. That is a promising sign. And unfortunately, as much as you environmentalists are going to disagree with me, it's bad for the environment, oh, this and that, oh, the turtles. Yeah, don't get me wrong, I care about the turtles. I'm not chucking 4 packs of Stellas into the ocean, even though they probably have a nice buzz on that. But the point is, and it's probably honest, it's probably got less. The ocean probably has more alcohol than the Stellas nowadays. Anyway, but I get off the point, and I think I've almost lost the point I was trying to make here. In fact, you know what? I think I have lost the point there because I was talking about Stellas. God damn it. Right. I think I was saying here that beauty long-term is growth here. They could use it, throw it out, get rid of it, and ultimately that's how it is. It's not going to be nice for you environmentalists, you that are very much following ESG. I believe very much in governance. I think Boohoo has a lot to improve in that department, but environmental, again, it's probably not something I want to concern myself about. There's enough people doing it. Don't get me wrong, I'm not necessarily throwing stuff out, but ultimately it's just how it is. And I think, yes, whilst I would like them to make a greater step to improve this, I'm not going to have them sacrifice profits for the name of reducing their synthetic fibres in their clothing, because ultimately a business is a business. Go tell that to the tobacco companies or the oilers. Like, don't even at Boohoo on this. And I don't know why I'm getting very aggressive there. But anyway, they also had an issuance of ordinary shares. Now, for you that may not understand this, and forgive me if you already do, but what they do is they are a package deal. So NED stands for non-executive directors, if you saw obviously the abbreviation that they used, and obviously total voting rights, but that's not relevant here. Basically, what they will do is they will take their salary for being a non-executive director, they will take a portion of that in shares, and they can't sell these typically, although it says a lock-up period, I think, but usually, yeah, it is. It's lock-in provisions for as long as the recipient remains a director of Boohoo. Therefore, they're taking a portion of their salary as shares and they aren't able to access that until they leave. So therefore, they're going to want shares to be rising by the time they leave so that obviously they're able to sell and get a lot of cash. This is good. This gives more power to the company, more voting rights, which is good. You don't want to take over of hostility, especially when there's insiders and you think the company's going to grow. More skin in the game, always a good sign. Don't get me wrong. The directors here don't have big stakes by any means. I mean 0.05%. Total number of 731,000 shares. That's equivalent to about 600, maybe 500,000 pounds. And yes, there's going to be private investors with more than that, but it's always good to see that. And I guess it really depends on how much Ian McDonald is earning, how much his net worth is, because if his net worth is only 800,000 and he's got 500,000 pounds in Boohoo, then fair enough, right? But anyway, that's that, and that's what it means. And then we also have Halma, a company I've not been following in a while. I felt they were very complicated. I felt they were buying things for too much of a premium. They were buying life-saving technology, which they are doing now. But they bought a technology company for a very overpriced, and it was software, and it was from the US. And I felt, you know what? I don't think this aligns with the company's promise to deliver value to shareholders. I think they've become a little bit too big. Their business model, their management are phenomenal, and their strategy of how they had grown so well in the last 20 years is fantastic. But I think obviously due to their scale now, they can't invest in the smaller businesses and really churn out cash flow, and therefore it's less promising for me. However, apparently they acquired International Light Technologies Incorporated, so it's likely American, yeah, USA, as a leading developer of technical lighting sources and light measurement systems. Very complicated stuff, which is used in biomedical, environmental, agricultural, food and beverage and industrial applications. The consideration for this is approximately £19.5 million on a cash and debt-free basis, which is great because obviously they pay off the debt usually as Halma. They use their cash flow to therefore fund more mergers and acquisitions, and they become this massive conglomerate behemoth that keeps growing and powering forward. This is a company that will consistently grow, but obviously it can't grow exceedingly fast the more businesses they have to look after. They grow a business, they generate cash flow. If it synergizes with the rest of the business, they'll keep running it. If not, they'll dispose of it, take the profit, use that money, reinvest. It's a big compounding growth machine, and ultimately if they do this well, they'll continue to grow extremely well. And I think really, I mean, I don't understand the company that well, but providing they are very specialized, they know what they're doing. If you're able to look at Halma and go, right, they're doing life-saving equipment, they're doing elevator safety systems, they're doing all of this, and you understand each individual segment, then this could be a phenomenal long-term hold, providing they keep debt down, they reduce that with their cash flow, and obviously they're strategic and their acquisitions aren't silly going forward. They could be a very good company, and they are a dividend, I don't know the terms, aristocrat, king and all of that. They've been paying a dividend and growing it by over 5% for something like 40 odd years. So although the yield now is very low because they're priced at a premium, obviously, quality company, one to be looking at. And obviously they've purchased this company for about £19.5 million. And the unaudited revenue for the 12 months of a year was about £7.3 million. And their earnings before interest and tax was about £2 million. So they're buying at roughly a price before earnings and tax to, well, no, they're buying at a price to they're buying at a price to profits before interest and tax of about 20 times, which is reasonable for a US company that is very specialized, but maybe a little bit of a premium. Again, you really need to understand this to truly bring more insight into this, but Halma has dropped quite a bit lately and could very much be one to follow. As always, thank you for watching. If you're interested in how to make £1,000 a month in dividend income, then click the card at the top right of the video. I will be getting back to all of your comments in time. I've just been extremely busy lately, but I will get back, and I will get back through the backlog. So if you've left a question there, I will get through to you. Don't you worry about that. And if you haven't already checked out my Patreon, link description down below. Have a fantastic day.